Like, share, comment, and subscribe. Follow Exodus Business Development channel to learn more. Modern Money Mechanics is a widely cited document published by the Federal Reserve Bank of Chicago in the 1960s. It was designed as an educational resource to explain how money is created and circulated within the modern banking system. While it is no longer officially published, its insights remain central to understanding fractional reserve banking and the mechanics of money creation. Core concepts from modern money mechanics. 1. Fractional reserve banking. 1. Banks are required to hold only a fraction of their deposits as reserves. 1. The remainder can be loaned out or invested. 2. This system allows banks to create money by issuing loans, as deposits made from loans can be reloaned repeatedly across the banking system. 2. Money creation through lending. Modern money creation doesn't rely solely on printing physical currency, Federal Reserve notes. Instead, money is primarily created electronically when 1. A bank makes a loan to a borrower. 2. The loan is credited to the borrower's account as a deposit. 3. This deposit money increases the money supply without requiring new physical cash. For example, 1. A bank receives a $1,000 deposit. 2. With a 10% reserve requirement, the bank must hold $100 in reserve but can lend $900. 3. The $900 loan, when deposited in another bank, becomes the basis for further lending. 4. This process, known as the money multiplier, can expand the original $1,000 deposit into $10,000 in total money supply, assuming no leakages or withdrawals. 3. Role of the Federal Reserve. The Federal Reserve regulates the money supply by 1. Setting reserve requirements, the percentage of deposits banks must hold in reserve. 2. Conducting open market operations, OMO, buying or selling government securities to inject or withdraw liquidity. 3. Setting the federal funds rate, the interest rate at which banks lend to each other overnight, influencing the cost of borrowing and lending across the economy. Federal Reserve notes and deposits. Under the framework outlined in Modern Money Mechanics, Federal Reserve notes, physical cash, are just one component of the broader money supply. The majority of money exists in the form of demand deposits, checking accounts, and other electronic balances created through loans. Criticisms of the modern money system. 1. Inflationary tendencies. Critics argue that the ability of banks to create money leads to inflation, as the supply of money may outpace the production of goods and services. 2. Debt-driven system. Since new money is created through loans, debt becomes a fundamental driver of economic growth. 2. This reliance on debt can lead to instability during downturns or crises. 3. Banking power. The system gives significant power to private banks to influence the money supply, raising concerns about concentration of control in the financial system. Summary. Modern money mechanics explains that money in modern economies is largely created through lending under a fractional reserve banking system. This system allows banks to multiply the initial money supply far beyond the physical cash issued by central banks. While efficient, this framework also raises concerns about sustainability, inflation, and the central role of debt in the economy. Don't forget to like, share, comment, and subscribe. Follow Exodus Business Development channel to learn